Good evening, and welcome to The Explainer. Tonight, we're taking a look at the quiet, constant hum of the subscription economy, and we're asking why, all of a sudden, it seems to be going silent.
You know, for years, our entire global economy has had a hum just like that one. It's that quiet, steady charge of subscriptions hitting our bank accounts for, well, everything. From our software and streaming services to car washes and even dog toys. So, what happens when that hum just stops? Because right now, a massive economic shift is getting underway, and it's forcing all of us to reevaluate every single one of those monthly charges on our credit cards.
So let's get right to the bottom line here. The subscription for everything model is breaking down. For the better part of a decade, we've all been living in the age of set it and forget it. But that era, well, it's coming to a close.
We're talking about a massive $3 trillion economy that's now facing a fundamental split. After all these years of unchecked growth, a day of reckoning has finally arrived. And it looks like only two specific types of subscriptions are really set to survive the fallout. Everything else is suddenly at risk. To really get why the model is breaking, we first have to understand how this enormous machine was built in the first place. And here's a hint. It wasn't really about customer convenience. It was all about financial engineering.
You see, Wall Street fell completely in love with this one single metric, ARR, annual recurring revenue. It promised something that investors find absolutely irresistible, a predictable, steady stream of cash that you could forecast, you could value, you could even borrow against. It was seen as so much more valuable than a simple one-time sale.
And Adobe, they basically wrote the blueprint for everyone else. Back in 2013, they moved all their famous creative software, Photoshop, Illustrator, to a subscription-only model. Now, the backlash from their users was intense. But investors, they saw the genius in it. Adobe stocks soared over 1,200% in the next decade. They proved that investors valued that predictable ARR far, far more than they valued customer satisfaction with one-time sales. And you can bet the rest of the tech world was taking notes.
So, what's changed? Why is this model that seemed totally invincible now starting to show cracks? Well, it turns out, three specific forces are converging all at once to create a perfect storm. Okay, let's break down how this storm is actually forming. The pressure is coming from three different directions simultaneously. From our wallets, from our attention spans, and from a technology revolution that's changing everything.
First, income shocks. It's pretty straightforward. As households feel the squeeze of economic uncertainty and rising prices, those discretionary, nice-to-have subscriptions are the very first expense to get audited and then cut. I mean, when money gets tight, you don't cancel your electricity, you cancel your fourth streaming service.
Second, we're seeing something called context exhaustion. We all know this feeling, right? You feel like you've seen it all. You sign up for a service to watch one particular show, and as soon as it's over, the platform's value just feels gone. This has created a whole new kind of customer, the serial churner, who just hops between services, optimizing for new content, not for loyalty.
And third, a force that is completely changing the game, AI disruption. The complex engineering that used to justify a high monthly fee for software is just vanishing. Today, a tiny team can use new AI models to build a powerful alternative to an established tool for a tiny fraction of the cost. And that is absolutely destroying the pricing power of the big established players.
Maybe the most powerful feature of this whole subscription economy isn't the products themselves. It's the invisibility of the cost. But that invisibility is starting to fade as people finally start taking a closer look at their own bank statements.
Just think about it for a second. If someone asked you, off the top of your head, how much you spend on subscriptions each month, what number would you say? Well, researchers asked people that exact question.
And the average guess was $86 per month. Seems reasonable, right? A manageable figure for most households. But then, when those same people were asked to actually sit down and go through their bank statements category by category, streaming, software, news, delivery services, the real number was, frankly, shocking. The actual average is $219. That is a staggering perception gap of more than $130 every single month. And this right here illustrates the problem perfectly. For the average family, that difference adds up to a hidden tax of nearly $1,600 a year. That is the sound of the machine humming away totally unnoticed until the day the audit begins.
So, As the market contracts, and all of us as consumers get a lot more selective, what kind of subscription business actually survives this big shift? What does the future really look like?
Well, the models that seem built to last fall into two very clear categories. First, you have true utilities. These are infrastructural services like your electricity or your cloud storage, where you're billed for what you actually consume. And second, you have services that provide fresh context, things that are always updated and can't be replaced, like real-time market data or a news feed. You pay because the value is being created for you right now.
So here's the crucial point. Everything else, that huge middle ground, is now getting squeezed from both sides. We're talking about the software that hasn't meaningfully changed in years, or the streaming library you've already watched all the good stuff on. They're charging a recurring fee for a static value, and that model is just not sustainable anymore.
So as this great unwinding continues, the question for you is a pretty simple one. Go look at your own bank statement. Which of your subscriptions are true utilities and which ones are just expensive habits? Because in this new economy, the businesses that survive won't just be on your statement. They will have earned their place there. Everything else is just noise, waiting for the hum to finally stop.